The people who are most thrown by private equity are professionals who actually work in finance. That's my experience anyway. And I think it's because they've been trained to think in a certain way about investment. And that's led to some distrust of private markets. But it's not really because they think private markets are too risky. It's actually because private markets break their definition of risk. You see, in public markets, risk is basically volatility. That's what it means. Whereas in real world investing, risk means losing money. And while that difference might seem fairly subtle, it means that private and public market investors are constantly talking at cross purposes. In this video, I'm going to explain the root of this confusion, and I'm going to give you a better mental model for conceiving risk and valuation when it comes to investing. To understand why so many financial experts are irritated by private markets, we have to understand the orthodoxy through which they see the world. For many, investment markets are public markets. So you'll heard of the classic 60-40 portfolio, which until recently was the starting point for most investment advisors. And that's a split between publicly listed equities and publicly traded debt securities. In other words, the 60-40 portfolio is a 100% public portfolio. Now, public markets are fantastic in many ways. They're very efficient at things like executing trades, buying and selling. They provide liquidity and they optimize for price discovery. You always know what the price and therefore the value of a listed asset is. But these advantages come with some big downsides in the form of constrained disclosure, because if you have to disclose to everyone at once, the public, that limits what you can actually say. In terms of short-termism, so everyone's waiting for the next quarterly report, and in terms of managerial agency costs, which we'll cover in another video. Private markets, by contrast, they don't optimize for any of that, not for liquidity, not for valuation certainty. They optimize pretty much for just one thing, and that is long-term investment performance. Now, it's going to be your assessment of that performance and how much of it you'll keep as an investor after fees that's the fundamental investment decision. But many finance experts don't get that far because, well, it all looks so different to what they're used to. It doesn't fit within their mental framework. So, for instance, with private market investments, you can't see the price of your underlying asset move on a screen. Valuations are very periodic, which creates knowledge gaps, and intermediaries hate that, understandably. And not only that, but when you invest, you can't just sell out whenever you want with nary a moment's notice. Well, actually you can if you invest through certain types of listed private equity vehicles, but that's a topic for another video too. Generally, you have to wait until the fund manager is good and ready to give your money back to you, and that could be years. And if you do try to sell out before then, you might have to accept a massive discount to the published valuation. So that means the valuation surely isn't real. That is the general impression amongst finance pros. There was an article in the Financial Times last week entitled "BlackRock says new regime of volatility is pushing clients to private markets." The argument was that because public markets are becoming very volatile, institutions are investing in the less volatile private markets because valuations don't correlate so closely. Well, the comment section just exploded and every comment was hostile. So people wrote of volatility laundering, when you don't mark to market but extend and pretend there's no volatility. When things go to zero, they're not volatile anymore. Massive fees so you can pretend your investments are worth more than they are. Hear no evil, see no evil. It goes on and on. So why is everyone getting so agitated? It's because these institutions aren't moving into private markets because of any demonstrable risk-return benefit, but because private markets provide a different kind of volatility, one that is uncorrelated to that of stocks and bonds. You might think that private equity and public equity would be pretty closely correlated over the long term, but we aren't actually talking about diversifying risk here, just volatility. To understand why that is, you need to know even stranger things. Most financial intermediaries are trained to think of risk very differently to its ordinary everyday meaning. And to understand this, you have to consider one of the foundations of modern investment orthodoxy, which is the efficient markets hypothesis. You'll have heard of it, but it goes something like this. Because public markets are very good at pricing assets through tightly controlled public information, prices must already reflect all the available information out there. Therefore, no investor can systematically beat the market. because they've got no basis on which to do that. It's a kind of a hopeless credo, and to be honest, not many people really believe it, but as often happens in relatively unscientific domains, rather than debunk it, it got layered with a concept called modern portfolio theory. And that basically said, yeah, okay, you can't win by seeking excess returns, but there is a free lunch through clever risk management, specifically by bundling together a diverse pool of assets with different risk profiles all into the same portfolio, in the belief that they will offset each other. So the classic example being an umbrella maker and an ice cream stand, which is reminiscent of the old riddle, what goes up when the rain comes down? And if you get the perfect combination of such uncorrelated assets, you get to something called an efficient frontier, which is a portfolio perfectly optimized for risk and reward. So this is what the BlackRock guy alludes to in the article when he says institutions are looking for returns that are not correlated with stocks and bonds. But as you will have spotted, these correlations and diversifications aren't really about risk. They're about relative changes in business performance, stock price movement. In other words, when finance people say risk, they really just mean volatility, which is a very different thing. It's strange but true that this expedient fiction really is the foundation of the modern investment industry. The risk is not the chance of loss, but how much the price of an asset fluctuates, and not just down, but up and down. I think the reason all these impossible sounding things have become orthodoxy is that they remove the need for subjectivity, which in turn makes the whole business of managing other people's money very scalable. Casually, it looks like they're doing something vaguely sensible, not putting all their eggs in one basket, when actually their goal is to merely smooth over short-term volatility, cyclicality. Volatility smoothing, you might call it. So I think the FT readers, they have a point. A lack of correlation is a weak reason to invest in private markets. It's a kind of a bureaucratic reason. It's the equivalent of smoothing out your map to avoid trekking on rough terrain. But the reality is that volatility is just not a reasonable proxy for risk. Real investors don't care about how much things go up and down in a day or a week or even a year. They care about having a decent pension or a savings nest egg. I'm sure you see what all this effectively means as well, which is the entire edifice of modern portfolio management does not actually account for risk, not as real-world investors understand the word. Some will complain I'm grossly simplifying their complex models, and I am, but when you build something, it's not what you put at the top that makes it robust, it's the foundational idea, what you have at the bottom, that matters. Right, so volatility is really important to intermediaries because it's the prism through which they see the world. Anything that messes with that effectively makes them blind and it makes them lose their minds. But what they get wrong is to imply there is something inherently wrong about private markets as a result, whereas in reality all that's happening is that the presence of private markets is exposing the absurd way in which risk is in public markets is viewed. Okay, so how are things different in private markets? Well, by comparison, the whole situation is pretty unsettling. Because assets don't trade freely, there's no constantly updated price, which in turn means there is no volatility data to plug into models, or rather the valuations look radically more stable than public market equivalents. And this has big ramifications because big institutions, they also see the world through the volatility lens. They need every part of their portfolio to have up-to-date valuations, otherwise things get out of kilter and they have to rebalance. This can be a real problem at times of heightened volatility when the stock market, say, drops 20%, but the private markets portfolios barely blip. So as a result, private markets funds are forced to periodically mark to market their investments. In other words, put a value on them during their holding period, even though they aren't changing hands. So the idea is that private markets fund managers guesstimate the price at which they and an arm's length buyer would transact. But critics say that these valuations aren't reliable, that they're stale because they're not done frequently enough, and they're biased because they're set by the fund manager. And that's actually all true. And yes, private market valuations are subjective and they can be abused in theory, although anyone that did that would quickly destroy their reputation. So there is a mechanism for policing that. I think all this criticism really reveals is how far from real investment that modern financial dogma has strayed from the interests of real investors. Think of it like this. If you invest in something, and I mean really invest directly in a project or a business, that means you're committing capital, you're putting it to work in the hope that it will result in greater productivity. You don't expect to be able to see the value of that investment change from moment to moment. Investment takes time. Even if you're really close to that asset or project, there'll be extended periods when the only reasonable thing you can say about the value of your investment is you do not know. Now, if all you're doing is trading the rights of future income in a very big, stable business, you probably can apply a constant value to that and adjust it as geopolitical events and interest rates change. But if there were a capital commitment spectrum, that's more like trading ownership rights rather than investment. And that's what public markets are for. That's what they're very good at, trading ownership rights of rent takers. But it's not investment, it's trading. The fact that valuation in private investment markets is subjective is not because of some accounting trick or reporting inadequacy. It's because valuation is inherently subjective. And the only way to change that is to surround an asset with all of the apparatus of public market investment. And as we've discussed, that comes at a cost. In private markets, the entire structure is set up for one overriding purpose, not equality of information, not price transparency, not the ability to change your mind frequently and costlessly, just long-term performance. Now, whether or not private markets fund managers actually provide that after fees, that's another question. But it's a question that many don't even get to because they're in this upside-down world where risk is volatility, valuation transparency is king, and investment performance plays second fiddle to the needs of the market in the abstract. I think the right question it's not how volatile is an asset, it's what real risks could permanently impair capital, and what are the incentives behind those whose duty it is to manage them. What we really face here is a systemic problem, and it's this. Real assessments of risk are not easily translatable into numeric values, and so any quantifiable proxy is better than nothing if you want to plug something into a model. The world has become financialized, and activities that seem closest to finance, like investment, have been reduced to methodologies that can be quantified, when in reality, as every real investor knows, investment is about potential. It's about judgment, not numbers on a screen. What we need are for investment intermediaries to be allowed to act as genuine authorities, empowered to apply their own judgment, not make decisions based on dogma or other people's models or the expediencies that serve bureaucracies, but the realities that serve real investors. It's also a problem of gigantism. With so much capital in the system delegated to the management of so few people, you're always going to end up relying on some formula or other. Maybe that's just the way it is. It just seems very odd to me that the one part of the investment market that offers something different is typically demonized and dismissed out of hand, when I think it should be treated as something more like an exotic creature that might have something to teach us. If you found this video helpful, leave a comment, give it a thumbs up and share it with your friends and colleagues, and do subscribe to the channel because we'll be posting more educational content as well as interviews with private markets thought leaders. Thanks.